You spend decades saving for retirement, but now you're asking, should I be playing it safer or am I playing it too safe? Because here's the truth. If your risk is off, even a small market drop could throw off your entire plan. It's a tricky balance, right? So let's break down how to align your investment risk as you make that shift from growing your wealth to protecting it. Hey, I'm Andrew Rafal, founder and CEO of Bayntree Wealth Advisors. And over the last 15 plus years, we've helped hundreds of families prepare for retirement by dialing in their investment strategy and avoiding costly surprises, especially when it comes to managing risk. And if you're within 5 to 10 years of retirement, this is one of the most important shifts you can make. So let's jump in. Step one is to know your real timeline. See, retirement isn't a finish line. It's really a new chapter. If you retire at 65, your money may need to last for 30 plus years. That means you're not investing just for tomorrow, so you need a long-term growth plan in your portfolio. Step two is to assess your current risk exposure. Take a look at how your portfolio is invested today. Are you too heavily weighted in equities, light on fixed income or cash, or just unclear of how much you could lose if the market takes a downturn? One way that we help clients figure this out is through a risk analysis. We often use software that quantify your risk tolerance and compare it to how your money is actually invested. Sometimes there's a big gap. If you're wondering where you stand today and want a simple way to check your overall retirement readiness, I recommend grabbing our retirement readiness checklist. You'll find it in the link below. It's a quick tool to help you get a clear understanding of your current situation, and it pairs perfectly with the steps that we're covering today. Step three, consider a time-segmented allocation strategy. So instead of lumping your entire portfolio into one, you might consider breaking it into buckets based on time horizon. So let's break it down. Your short-term bucket would be 1 to 3 years, and this is your sleep at night money. This might include cash, money markets, short-term CDs. It's typically reserved for near-term expenses, travel, home updates, lifestyle needs, things like that. Your moderate or midterm bucket is money you need in the next 3 to 10 years, and this bucket is generally more balanced. Some people use a mix of bonds, dividend-paying equities, or more conservative funds here to seek modest growth with a lower volatility. And then finally, you have your long-term bucket. Think 10 plus years. This is the money you may not need for a decade or more, so it can stay invested for long-term growth. And this might mean a mix of stocks or things like real estate or other long-term opportunities, just depending upon your strategy. The big idea here is that segmenting your portfolio by time horizon may help reduce the risk of needing to sell investments during a market downturn just to pay for your everyday life. Step four, build an income plan, not just an investment plan. So you want to ask yourself, where will my income come from once I stop working? Will it be Social Security? Are you fortunate enough to have a pension? Do we have rental income or withdrawals from your IRAs and 401? Your investment risk should match your income strategy. So if you're planning that most of your income will come from your portfolio, you'll need to be especially thoughtful about that sequence of return risk, which is when poor market performance early in retirement can hurt your long-term outlook. That's where a cash flow projection or retirement income plan comes in. We run these all the time for our clients, and it helps bring all the moving parts into one clear picture. Step five is to review and adjust each year. Listen, the markets, they change. Your goals, they change. So your plan should never be set it and forget it. Make it a point to review your plan, your portfolio at least once a year, and ideally with a retirement-focused advisor who can look at the full picture. That includes investments, but taxes and income and your risk exposure. Listen, the bottom line is aligning your portfolio risk as you approach retirement is just not about being conservative. It's about being strategic. So remember that you want to stay invested for long-term growth, protect against short-term volatility, and really just match your investments to your overall income needs. So if you're unsure whether your current strategy fits where you are today or where you're headed, it's worth having that conversation with a financial advisor. So if you found this to be helpful, be sure to like and subscribe to our channel. We share videos like this every week to help you make smarter moves as you head into retirement. As always, thanks for watching. I'll see you in the next one. Happy planning, everybody.